As always, you will start by plugging in the cost of the asset. And once again, we will have $8,000 of accumulated amortization, 4,000 each for the last 2 years. We will have a change here. We have a new salvage value of 3,000. And then we also have a change in years. We're going to only last 2 more years. That's all the information we need. And I go ahead and put down 2. After you do the math, you should end up with a new rate of 5,000 per year. So the truck is expected to last a shorter time, but it's expected to have a higher salvage value. After we do the math, we increase our amortization rate for the remaining life of the asset by $1,000 per year, from 4,000 to 5,000. Under these new estimates, the truck will be amortized $5,000 per year for the next 2 years and will reach its salvage value. Note that if an asset is fully amortized, it can continue being used, but no further amortization is taken. It can also be disposed if it's no longer useful or has become obsolete. You should try to stick with the plan when you're setting your amortization rate and you're amortizing your asset, but there's really no obligation to stop using the asset if you still find it useful, even though it's been fully amortized. Disposing PP&E. When a business sells or trades in a capital asset, 3 important steps are taken to correctly record the disposal. First, we update amortization. Make a journal entry to update amortization on the asset. If the asset is sold partially into a reporting period, we must calculate partial amortization prior to making the journal entry. Step 2, we're going to calculate the gain or loss on the disposal. This is done by subtracting the sale price from the asset book value, cost minus accumulated amortization. So this can actually be a little bit tricky if you have a lot of moving parts to your transaction. And sometimes it's easier to just go to step 3, which is usually what I do. I skip step 2, I go to step 3, and I come back for step 2 at the very end. And you'll see how that is done. Step 3, make a journal entry, remove the asset from the books. So we debit the asset accumulated amortization account. We credit the asset account. We take it off the books. So you take the asset off the book, you also take its accumulated amortization off the book. So it's no longer anywhere to be seen on your books. You debit the payment and or trade-in. So sometimes you get a new asset back, like a piece of equipment or vehicle. Sometimes you get cash. And finally, you record the gain or loss on disposal of PP&E. So that's what you're calculating in step 2. Let's try a simple example where the bookstore sells its desktop computer on December 1st for $200. So if you recall, we bought this computer on January 1st. We were planning to use it until December 31st for 1 year. We billed a month early. We sold it for $200 on December 1st. So we were amortizing on a quarterly basis and our rate was $200 per quarter. If you need to refresh any of this, feel free to pause the video and go back and look at your notes. But since we didn't finish that last quarter, the fourth quarter, we only take 2 out of 3 months on it. So the last quarter ended on September 30th. Then we had the full month of October and the full month of November. And that's it. We sold the asset on December 1st. So 2 months have been completed. So we say $200 per quarter times 2 months out of 3 in that fourth quarter. And then we'll get 133. So we can do the same calculation just by going the annual rate times 2 over 12. So 800 for the full year, October, November, 2 months out of 12. You should also get 133. So then we make a journal entry before we dispose our asset. Make a journal entry, bring the amortization up to date. So December 1st, amortization expense, 133, and accumulated amortization with a computer. Credit that for 133. So that's our amortization now up to date. So step 2, again, I'll show you how to skip it in the next example. Note that the amortization schedule shows that the asset book value as $300 going into the fourth quarter. So that will be straight out of your straight line amortization schedule earlier in your note. So after quarter 3, we have a book value of $300. The adjusted book value after adding in amortization from step 1 is 167. So 300 to start the quarter, take away 133, you're left with 167, which makes a lot of sense because 67 more was going to go away in December. You'd have your salvage value of 100. Now we can calculate the gain or loss on disposal of PP&E. So how do we do that? We go sale minus book value. So sale price was 200. Book value is 167. Therefore, we have a $33 gain on sale. And step 3, we're going to go ahead and make our journal entry. So follow your steps. Date it December 1st. We're going to have accumulated amortization, which is a credit account. We're going to empty it out in one shot. Only for the computer, of course, not for everything in the organization. So computer, getting a little bit tight here. We'll manage. It will be 733. So this number comes from 600 straight from your schedule and 133 more, which we just calculated 2 months out of the year. And then we have collected cash. So cash goes up. It's a debit of 200. And then I'm going to go down here, skip a line. I'm going to go ahead and fill in my asset, which is now off my books. The computer. Remember that it's shown on the balance sheet at historical cost, according to historical cost principle. So 900 is what we paid for it. So this is what I meant when you want to calculate your gain or loss on sale. You can just look at the credits and debits and see which one's missing. So we have 900 as our credits. We have 733 plus 200 as our debits. So that's 933. That gives us the difference of $33, which we'll fill in as a credit. And you would have to memorize that when you have a credit difference, that's a gain on sale. If you have a debit difference, that will be a loss on sale. So that's how that is done. And feel free to abbreviate PP&E. I don't expect you to write down property, plant, and equipment on your journal entry. It makes that pretty messy. That's our journal entry all done here. Now let's look at a more complex example. Trading in capital assets involves a similar process that we just completed. Assume that on December 31st, 2021, the bookstore trades in its used truck for a new truck worth $32,000. In addition to giving up the old truck, The bookstore pays $25,000 cash. It's a typical trade-in agreement. You don't get to trade in for free. They usually give you some kind of credit for the trade-in, and then they take your cash. Assuming the bookstore uses the units of production method, what is the gain or loss on disposal of PP&E? So we get a little bit of a break here because it's right at the end of the year. Our amortization entry is all done. We do not have to adjust amortization since the asset is sold exactly at the end of the reporting period. Accumulated amortization and asset book value on December 31st, 2021, shown in your amortization schedule, is up to date. The simplest way to calculate the gain or loss on disposal of PP&E in a complex transaction such as this is to simply fill out the other items in the journal entry and calculate the debit or credit needed to balance the entry. Remember that the gain is a credit and loss is a debit. So that's the key. You have to remember what's credit and what's the debit. Gain is credit, loss is debit. So we'll just jump right in and we'll start plugging in numbers. So amortization, no issue. We'll get the debit to accumulated amortization again, and I'll try to write smaller this time. Accumulated amortization. I'm going to label this old truck, just so we're very clear that we're getting a new truck and this is the old truck coming off the books. Well, the amortization for the old truck coming off the books. So if you look at December 31st, 2021, you'll see the amortization in our schedule is $12,000. Our next debit will be a new truck, because since we're getting a truck, we have to add it to our books, and the value of the truck is $32,000. Now I'm going to leave a line because I'm not sure if we're going to have a gain or loss. So this one here could be either a debit or credit. So we'll leave that line and we'll come back to it. Let's take the old truck off our books. We've taken the amortization off already. The old truck recorded at historical cost on our balance sheet is $21,000, coming right off the books. And then we also gave up cash, right? That's another thing that has to come off our books. And we paid 25 grand. So I suspect you can see where this is going. You typically not going to make a gain on a trade-in. They usually try to get the best out of you. So you have 32 plus 12, that's 44,000 in debits. And you have 21 plus 25, that's 46 in debits. I think I'm going to write it down so you can follow. We have 44,000 DRs and then 46,000 CRs. Of course, that's a difference of 2,000 and it has to be on the debit side to make this journal entry balance. So I'll fill that in. And as you remember, a debit is a loss on sale of PP&E. So you can write down sale of PP&E or you can write down disposal of PP&E. It's really your call. There's a little bit of variance in accounts across organizations, and it's your own personal preference anyway. You develop your own style as an accountant. Alright, so let's wrap up this chapter with some intangibles. As promised, we'll talk a little bit more about goodwill and also copyrights. Recall that intangible assets are assets which have no physical form but provide benefit to a company. Copyrights are exclusive rights to reproduce and sell software, a book, or other unique good. Imagine if the bookstore bought copyrights to a book for $10,000 for the next 5 years. $2,000 of the copyright value will be amortized each year for 5 years. Similarly, a patent is a government grant which gives a party exclusive right to produce and sell an invention for a period of time. Goodwill arises when a premium is paid in the acquisition of a company. Often goodwill is credited towards the company having a recognizable trademark or brand name. If the firm's established reputation gets damaged in any way, goodwill is considered to be impaired and should be written down. So let's say if you took over a business a couple years ago, someone was retiring, they wanted to sell, you got a good price for it. The difference between the book value and the market value, so you might have paid $2,000 extra for a gentleman's old car mechanic business. You integrated that business into your own organization, being a car mechanic yourself, and the value you got out of that was a bunch of customers which had been with the mechanic for years. They now became your client. However, if you check the client list after a couple of years and you notice that half of the clients are no longer with you, they've moved on because they didn't want to switch mechanics, but they wanted to use somebody else, then you should write down half of the goodwill. So there's some kind of quasi-science to this, pseudoscience, I should say, maybe a better word, but that's kind of what it means. So that any time you take over somebody's business and you pay a premium, the premium means something. So it could be a client list, it could be a brand name, it could be something like that. But you should test to see if you still have that value every year, I would say, or even sooner. And if you don't, you write down goodwill. That's it for chapter 10. Remember to try the homework as well as the quiz.